Welcome to FX Street Currencies in Play, sponsored by Royal Financial Trading. I'm joined by Ed Matz from matrixtrading.com. How are you today, Ed?
I'm very good, Zach. Yourself?
I'm okay, bearing up under the stress, or the strain rather. There's no stress, obviously. What are the highlights on the currencies markets for you at the moment?
I think the overriding factor is one word, Zach, and it's July. A lot of people, let's step back. I mean, at Matrix, what we look at is what we tend to look at is what we think is driving a market, whether it's fundamentals, intermarket relationships, the technicals, the sentiment, what we call fits analysis. And if you step back and ask yourself what is really going on with July, historically not a lot in foreign exchange. It's a very, very choppy month. I don't know if you've got some the ATR charts in front of you there, but basically what it's saying is the market is in foreign exchange is chopping about, and you've got to be very careful about pursuing a trend. Obviously, one thing we all
let's go to the trending topics first, then we'll go on to your charts, which is we want to do them properly. First up is pound dollar, pound gains back losses against dollar after strong UK jobs data. WTI crude rises after US crude inventories drop, and then the markets await Yellen and Yellen testimony later today, and that will be the key focus. Obviously, there is a bit of a focus on Trump Jr. as well, which I was hoping you might mention, but obviously you didn't.
Sorry, Zach, I forgot your wonderful template. Yeah, I mean, the obvious thing that's driving this market is a choppy July. Secondly, yes, we had a flash in what we call a smouldering pan yesterday with Trump Jr., and the markets whipsawed backwards and forwards, which is it's important to realize with July what the type of month it is in foreign exchange. People pursue trends, look for trends, but by and large, in foreign exchange at least, we don't see it. If you look at the average volatility for the period for July, it collapses.
Let's have a look at the ATR that you mentioned. I think that's the first slide there. So ATR seasonality, what does that mean?
Basically, ATR is average true range. It's the daily volatility you see in this case in euro dollar, dollar yen, and cable. And you can see that although there are clear periods in the year, particularly in the latter part, the third quarter, where you start to see trends develop, there is a complete collapse in volatility during July. Now, whatever reason, people going on holiday, historically in London, people go to, they go off to Henley and the likes, Ascot, the season, but it generally means in July it turns into a very choppy month. So identifying what are the real trends or not, as the case may be, is difficult, but it's also important because we all want to trade with the trend. I mean, rather the way we should look at it is trade with the probability. So if it's trending, the probability is for the market to continue with the trend. If it's ranging as July does, then that's the probability. You want to trade a range, and that begs the question, what is the range? And also one thing about July, it doesn't respect levels. So you almost want to enter where people are stopping out, fading. And in the case of euro dollar, you can see that we're entering what is a very low volatility, very choppy month. So although the euro is strong as a currency, primarily because of the fall in bund yields, the 10-year ramping, and that's likely to continue for the foreseeable future. In terms of the dollar trading, that's a different ballpark, different game. And if you look at yesterday, what happened on the back of Trump Jr., which is for us, or the research we've done into previous instances like Watergate, Monaco-gate, one thing we do is try to look at what's happened before, historically in similar conditions, similar markets. And yeah, you can draw a comparison where everyone wants to, every Democrat wants to draw.
Let's move to that chart, because I think we've got a good example of that. Watergate, I remember it well. What's going on there? Where are we can see where we are on that particular comparison.
Yeah, now, as I said, one thing we like to do is confronted with similar conditions, what does the market do? In other words, if Donald Trump was walking into a Watergate where he's going to be impeached or resign before he's impeached, then you're looking obviously at a complete and utter dollar collapse. Now, that's a no-brainer. But is the price action following? Well, what we've done, Zach, is we've looked at the sequence of events, both for Watergate and I think more interestingly, Monaco-gate, to see the impact of that sequence of events, or if you like, the shift in the burden of proof or evidence or no evidence, and see what effect it has, not just on the dollar market, but more interesting perhaps in the stock market and in fact yields as well. And yeah, you can see what impact the Watergate would have if and when it happened. But if you want to flip to the next chart.
Yep.
Monaco Gate. Now, what all the market, not all, pretty much 75% of the markets are following the Monaco Gate sequence of events in terms of evidences, but sequence of price action movements. And you can see it actually supports, it's saying that at the end of this process, you know, in a month or 2 or 3 months' time, the dollar does fall, but it's going to stay sideways, which is intuitively makes sense because it's July. But it's saying basically the dollar's probably shot its bolt for the time being, and as evidenced yesterday by Trump Jr., you know, the emails and everything else, the dollar goes weak, stocks come off, and yet at the end of the day they go back. And it's actually what is quite interesting as well is since Donald Trump started his campaign, in fact not his election, started his campaign, when you've got bad, or what the market perceives as bad Trump news and the market falls, it ends up net higher in about 3 to 5 days time. And you've already started to see that, certainly with stocks, which are back, if not higher in the case of the NASDAQ, but also in the dollar. The dollar shoots, you know, it's weakened, euro dollar's up at 114.90, and now it's backing off. And that is likely to characterize the month of July, where we get whipsaw trading. So the trends, the euro is strong, the dollar isn't, it's sideways. And that's reflected also by the sell-off in yields, having spiked 114.30, the previous high in dollar yen.
Okay, let's go on to the next slide, which is the Humphrey Hawkins affair.
Yeah, the next 24, 48 hours, Janet Yellen, God bless her, is going to present to the House first and then the Senate as to, you know, the outlook, if you like, for the next 6 to 12 months and what the US economy is doing and what is the Fed likely do. Well, there's nothing likely new to come out of that. And the market has, where there is an event where the market will position or looking for some sort of feed or hint as to where the market should go, it tends to happen, trade in a very typical way. In other words, it tends to repeat itself. And as you can see again, it's very, given what it did last year and previous years going back about 10 years or so, it weakens into it and then ramps, comes back off, and then ends up net higher. Which all of these things are saying the same thing. It's July, it's choppy, it ain't going nowhere fast because it is moving about quite a bit. But the net result is the dollar is probably overdone, but not the euro. Remember that boom market, keep an eye on the boom market because that is leading euro as a general currency rather than, say, euro dollar, which is obviously dollar related, and obviously US yields are going with that as well.
Okay, let's go on to the next, we can go to the next slide there, which is perhaps also the most exciting of the lot. We've got the hourly euro chart here. What's this telling us?
114.90 exact is what it's telling you. Anyone who, you know, one thing we look at a number of different techniques. One of them is Elliott wave, because Elliott wave is one of the few techniques that allows you to bring in the fundamentals into markets, technicals, and sentiment all in one chart, if you like. And I've got to confess, we weren't quite expecting to see 114.90 quite this early, but it's a 5=1 equality target. Doesn't necessarily mean it's going to reverse aggressively forever to the downside, but it does mean it's toppish, and we should go back, probably whip back below 114.30, and you know, it's taken the stops out. Now it's taken the stops out. Hello, July choppiness. Back down it goes before it gets back into what will now be a 112.80, 114.90 range. So we're short euro dollars, but we're selling rallies, looking for that movement back. And then below 113, again, choppiness. Given the Monaco Gate scenario of sideways, given Humphrey Hawkins as well saying whipsaw, trade the range, yeah?
Okay, well, let's. This is the euro, but we're going to discuss the Kiwi with Michael Moran just for a couple of minutes. So, Michael, you're going to talk about all things Kiwi today. There have been some exciting movements on the currency, possibly the most exciting thing about the country, actually, in the near term.
Yes, that's a very good observation and very true. The Kiwis just done one of those moves that are, I would say, unique to the Kiwi. It started falling at some stage yesterday. The supposed excuse was a 6.6 magnitude earthquake just off the coast of the South Island. It was a minor earthquake and there was no damage reported, no tsunami threat issued either. So I think this is probably a catalyst for a move where there were some bigger players trying to get out of their Kiwi positions.
Right, and how far do you think the Kiwi can fall? I mean, is that's the real question now. Was that just a blip, or is that something that can continue?
I think it can continue. The fact that it didn't recover much in spite of a falling US dollar and a rising euro, I think there's probably a little bit more behind it. I'm looking at on my charts, and I'm not an expert chartist. I'm really more of a fundamentalist. But I think we can get down to the mid-70s, 70, 40, 50.
Right, well, I am an expert chartist, and I actually agree with you. The real thing now is, I mean, for people who don't normally trade this currency, because that's the thing, it's not really, it's a bit of a side market, let's say. Is it something that they should now look at?
Yes, it's an exciting currency. You just need a bit of discipline, but when it moves, it's unique that it can move. It's one of the characteristics of the Kiwi through the years is that the liquidity, whenever it starts to move, is a lot less than some of the other more liquid currencies. For example, the euro or even the yen. Sometimes the equivalent of the sterling. So when it moves, you can get some good mileage out of it.
Okay, well, let's go on to the second chart that you've sent us, and so what's this telling us then? This is the longer view.
Okay, is that the
the view over since the start of the century?
Oh, that might be the Kiwi TWI?
That's right, yeah.
Yes. Okay. One thing that the RBNZ, as far as I can remember, are more conscious about is, and including the RBA, but the RBNZ to a larger extent, is the Kiwi TWI. That's the trade-weighted index of the Kiwi against its major trading partners. So there's a lot of it now in Asia, but there's a big chunk of it in the Aussie. That's why the Aussie Kiwi chart is one of the charts that a lot of people focus on. But that's beside the point. I think if you look at the long-term chart, the Kiwi TWI is near the high end of the comfort level of the RBNZ. So it's managed to move up to that level between 78 and 81, which is the top end. If you can see through the years from 2000 all the way to 2016, 17. So it's had its blips there, and it hasn't really moved down much. So that's one thing that they would be keeping an eye on and possibly concerned. I mean, the reason why the Kiwi has been a very strong currency is obviously, if you look at the yields, 10-year Kiwi yields are just over 3%. US are 2.37. It's the highest among the developed nations.
Right, and so just as far as the other currencies are concerned, are there any other highlights you're looking at?
I'm not convinced that again I'm one of those that are not convinced that this is a general broad-based dollar move down. I think it's more a euro move up. So we could probably know in a few hours time when Yellen comes out. All it does is it just gives some good volatility for traders to get involved in. Michael,
thank you very much indeed.
You're very welcome. Thank you.
Okay, let's go on to what people are actually trading positions at the moment. Basically, we're 60% plus on the euro dollar, cable, and dollar yen. Any views on that?
Me?
Yep, Ed.
Yeah. Sorry, no. I was enthralled by the Kiwi stuff.
It was a good story.
No. It's the thing about the Kiwi is it loves to whip. In fact, the dollar Kiwi looks a bit like the FTSE chart, but Aussie Kiwi looks like it's a head and shoulders. Everyone should look at the head and shoulders and then watch it ramp for 40, 50 points and then rip back and stuff everyone. Anyway, in terms of cable's doing something very similar. Cable is following a historic pattern from 2001. It's a declining wedge. It's ramped at 130.45. If you want to draw an analogy, it's one thing we do a lot of is look at other markets, see something similar. 130.45 is the same as 77.55 on the Aussie. Brick wall resistance. Goes to it, sells off. The market then tries to buy the dips, and that's what they're doing. It'll spike down. They'll then stop out, get short, and they'll ramp back up. Cable, I think, is basically working its way lower, slowly but surely. If you want to be short sterling, there are better vehicles, arguably sterling yen, long euro sterling. But if you've got the patience as we're trying to have, we're staying short cable, and when people are stopping out and selling, take it back, and as they get bullish again, sell it again. It's just 3 steps down, 2 steps back up on cable, so it's working its way lower. It's one of the, as the previous speaker said, it's a euro move, not so much a dollar move, and one of the beneficiaries of dollar going sideways, or one of the victims, if you like, is going to be sterling, and therefore cable going lower. So it's sell rallies and cables, don't sell breakdowns.
Well, you mentioned the Aussie, 67% short on the Aussie, traders, banks and institutions. Is that something you would agree with?
That I'd be 67% short.
Well, 67, yeah,
67% short. About that, I'd like to sell some more, but it's the Aussie is a very, very slow burn. What's it done for the last year, Zach? I mean, in terms of July, talking about July choppiness and range trading, that's been the Aussie for 2017. It's 73.50, 77.55 range. You know, it's up the upper end. You want to sell the upper end. You're going to see a sharp drop back down. Actually, on the Kiwi could impact it if this is interesting. If the Kiwi squeezes people by going back up on what is perceived to be, no disrespect, a non-event earthquake, because obviously it's a big event for the people affected, then you might actually see the Aussie get kicked into touch as Aussie Kiwi comes down. It depends where the positions are, but if people trade their head and shoulders on Aussie Kiwi, they'll get long of Aussie against the Kiwi, and then they'll have to throw the Aussie out and you'll break back down. But basically, above 76.50 on the Aussie is a sell. Below 76 in the short term, you don't really want to sit there short unless you're going to stay with it for a week or 2 weeks. So Aussie is, again, I mean, gosh, 2017 is July for the Aussie.
Okay, well, let's go on to the economic calendar, just the highlights of the day there, where basically, I suppose it's Janet Yellen speaking, as you mentioned before, Bank of Canada monetary policy report, and then the Bank of Canada interest rate decision and rate statement and press conference. So it's all about basically Canada as opposed to Janet Yellen.
Yeah, the market's focusing heavily on Canadian strength. It's funny, Zach, how when dollar Canada's above 135, the Canadian economy is going to collapse, and now it's below 130. It's the best thing since sliced bread. And what is really weird and bizarre is try and trade dollar Canada with an oil chart, and it will screw you. It actually tends to move with oil. In other words, as oil goes up, dollar Canada, basically dollar Canada goes up as well, which means Canadian dollar weakens with oil and then has a delay for 2 to 3 days. So dollar Canada, if one market, because the euro is obviously very strong and a lot of the euro crosses have gone already, one market I'd be interested in looking at and buying weakness is euro Canada, because I think the market is getting overly bearish dollar Canada. But it's going to take a while for it to turn, because the sentiment and oil rallying as it has done the last couple of days, people will continue to sell dollar Canada, but it will come back in their faces, which means if you can leg into euro Canada, in other words, wait for the euro dollar to come back below 113, buy euro, and then look to buy dollar Canada, maybe even get it below 128 in the short term, then I think you've got yourself a great synthetic euro Canada long, probably with a stop below the current low. Just obviously haven't got a chart to show you, but there's a very solid support area, and it's now consolidating that base. So you've got to be careful at looking at too many things at the moment on dollar Canada, certainly not oil. It's a yield-driven play, and the yield move appears to be running out of steam.
Ed, Mats, thank you very much indeed. We're all running out of steam now. That's it for FX Live Currencies in Play, brought to you by Royal Financial Trading. Thank you very much.